when I'm talking, so I have to switch back and forth. But it does appear that we are live. So, okay, folks, I'm going to share screen. We're going to start this thing and get it going. So, should be seen. You should be seeing right now. You're seeing TradeStation, right, folks?
Yeah, correct. Yeah, we're seeing TradeStation on
Okay.
the Zoom side.
Okay, good. Yeah. So anyway, so what I did, and if you folks have never done this before, if you're a PX user, you could, like I said early on when folks were joining. Hang on, I got a bunch of folks that aren't admitted. You know what that's like, Jay. Um,
Yeah.
the room's almost full, so that'll solve that issue pretty quick. So, but yeah, so what you can do with Portfolio Expert is nice. Is it has an internal web browser, and I'm kind of disappointed because Jay and I were playing yesterday, and we're hoping we could put multiple web browser instances in the platform, and that would give us the ability. We could have quotes, we could have all kinds of stuff in here. Unfortunately, it's only letting us put one web browser, and I don't know if it's per instance and per page or not. That's something we can see. I'm not going to worry about that functionality today. But what's nice is there are things in Wavetech that do not exist in Portfolio Expert, and so this dashboard here is one of those things. So it's nice to be able to just bring this in, and all you have to do is you click. You can do a window show view, and what that does is allows you to add views to the screen. And there's, if you haven't seen that functionality, there's all types of things that you can add here, and stats and different windows and things that happen. And I've covered most of those in the videos on the support area as far as that goes. So that's not the goal of today, but it is nice to know that you can put this in, and you can double click on you can just double click on a tab, and you can open this to a full page, which is also nice. So you can toggle back and forth between the products, and they work together. In fact, and talking to IT, the developer that did all the development, he's been with me for 20 years. We were talking just the other day, and there's elements of the database of Wavetech that Portfolio Expert actually pulls from, and that is so they really do work together internally as well, and the back end as well as on the front end. There are views there. So one of the things I want to I'm going to attempt to do a good job at. Jay did a lot of work on Michael Orenson's work that he did in finding some stocks, and I'm going to set up. I'm going to bring you into a PowerPoint for a minute, because this is, for me right now, this is going to be a theme around the channel on my daily videos. Like I said, I'm working on a project that I've gotten in total mad scientist mode, and I'm really excited about it. And I have a history of having a good vision into the future, we'll say, in when it comes to markets and trends and things of that sort. And I've been doing this a long time, and I'm not going to bore you with telling you what I said when I can't validate it other than folks that have known me for a long time. But the point is that what we want to do here is take a look at this infrastructure stuff and actually try to determine exactly what's going on. I'm going to move. I told you guys I've moved that off the screen here so you can't see it. But let's go ahead, and I want to go to this PowerPoint that we worked on overnight. And this is I'm going to just not go through these screens. I want to just reference them. I am going to use these screens in a video and some other projects that we're working on right now. And so let's go ahead and take a look at that. So this is the $2 trillion. It's $2.2 trillion breakdown of the infrastructure from deal, and we're just going to glance across this, and not going to talk. Most of it's, they're saying it's paid for a slew of tax increases. This is basically BS. It's actually being paid through MMT, and I won't go too much in depth here, but this is the thing that I want you to see here is these are the breakdowns of the major categories of everything that's going on as far as this deal goes. And housing, education, 778. I'm just going to reference these, like I said. These are breakdowns step by step, what's going to be spent on different areas of this deal. And 621 on transportation. Okay, and this is the breakdown here. Elon Musk has got to be thrilled, 174 billion for electric vehicles, and modernizing roads, hard and bridge, 115 billion. That's basically a joke. There's, if you look at this, Amtrak's getting 80 billion, and freight rail services. But anyway, I don't want to go. The goal is not to go in detail, but to point out that there are cash flow that's going to be flowing around the markets, and just kind of going through here some more. Manufacturing labor, 400 billion, and so it just goes on and on. So I'm just going to keep going. Manufacturing labor, these are the breakdowns. I'm going to do a video on this stuff and break this at a more serious level here. So there's a lot of things going on. Broadband, 200 billion, so they want to have high-speed internet to everyone. I think Elon Musk has already figured that out. They're a little late to the party. But anyway, it just goes on and on, right? Research and development. And here's the breakdown. And water infrastructure. I think this is the final one here. Is about it. Let me just see here. Yeah, this is the final page. But you get the point of what we're talking about here. Is we're really just talking about a lot of money going to be spent. So thanks to Michael Aronson did this work. Thank you, Michael. This is pretty amazing. But went through and this is the beginnings of what I think is going to become a very concerted effort to start to find stocks that are going to participate in these money flows. So this is a spreadsheet of everything that is out there from the standpoint of different symbols. So I deployed Jay to go in and actually build some portfolios on this stuff, just so we can start to get some ideas. And he's going to work with me on showing what he did, and some of those things will be what we do next. And so I just want you to see that this is going to be the effort. And the interesting thing from my viewpoint is that I've got an army now, and never had an army this big. You know, we've got 30,000 people on the YouTube channel. I've got 20,000 on LinkedIn. I've got a lot of outreach I can do, and a lot of folks are willing to, throw their 2 cents in. And I'm going to be setting up a special email. So if you have ideas on infrastructure, things you want to share, that you'll be able to email to that email address. And I'll be letting you know that probably through a email that we'll be sending out to you that are subscribers or on our mailing list, just to start to really figure out how we're going to be able to profit from this massive amount of monies that are flowing throughout. Hang on. That massive amount of money that's going to be flowing out of through the markets and through all these industries, and how to make a profit here. So that is the goal of what we've got. We got a few the people on YouTube. So thanks for joining us. Volume is low, they're telling me, so of course it is. Not sure what's going on. Anyway, so let's take a look at some of the things that came out of this research, and we started to build, and we've got a bunch of these. I'm going to show you the cluster. Jay, did you build any more since we talked?
I did a few, just a few multivariant models. I think I did about 3 more since you and I talked last.
Really? Okay. So those of you, if you're a portfolio expert user, you won't be able to do exactly what I'm doing because I have, I see, yeah, there's a few there. So you can actually share your portfolios with other folks if they know how to get to you. And so this will update my list there. That's updated the list. And what I'm going to show you here, these are all of the strategies that have been, these are all the strategies that were developed from that list. Jay, you probably know, since you built these, you probably have, you can see varying returns as far as this year goes. There's definitely a cluster of elements coming around, some better, and we're also using the multivariant approach, which would be utilizing daily and weekly charts. And we'll break down on some of these things and how they were built and what the things, I guess the best things you can do to try to implement these type of strategies, whether you're using Wavetech and all that. Jay, did you build anything? You didn't build anything in Wavetech, did you?
Negative, not in Wavetech yet. This is strictly expert
Okay.
right now.
All right. So we'll stick on PX, but this stuff we'll cover it enough that we'll put some of these ideas in. You know, I've got some ideas, so I'll tell you after the show, Jay. I just thought of something what we can do to get that up. But this is the list of everything that was built. We can make this full screen so we can see the returns of these strategies, and this goes back just a short period of time. If we start to go, how far back do you go, Jay?
I went to 2015.
Okay, so here we are, 2018. Let's go 5 years. I think it's going to blow up if I go to 10. No, there we go. So this is all the different returns. So this is when you're building a strategy out. This is what, these are all from the same list of stocks, correct, Jay?
Yes, they are.
And so what basically what we did was just built everything out, but this is the collage of everything we built. So we're trying to, what we have to do next is figure out which ones have the attributes that you want to be, you know, what are the characteristics of the portfolio you want? Volatility, pure returns, you don't care about volatility. Those are things that you're going to get, and a lot of that stuff you're going to find in the, you're going to find a lot of that stuff by going through rolling returns and those type of things. So I think what I'll do as we go through this is we'll talk a little bit about the construction. We'll talk a little bit about the review and looking at these things, and then we'll look at the output and just see what kind of volatility versus other things, and see what we can come up with. So let's go ahead and. So Jay, you want to pick one of these off the list that.
Well, one of the ones I really like, well, the one that's already been performing better, like semiconductor, the Real-Wiz, the daily, weekly mix.
Right, this one here.
Lower. Go down. Well, yeah, I like the budget gourmet ones. Those are actually, I was trying to pick, that's a mix of all the symbols from the whole entire list, and I was trying to pick stocks that are under $40 a share right now, and just trying to try a few. Those actually started with $20,000 starting equity, and they did really well.
Okay.
Even just with 20,000. I was just testing a couple different
Okay. Yeah. No.
ideas.
So I highlighted both the Real Whiz. Is that the two?
Yeah, correct.
And the bottom one is
The budget the blue is the budget gourmet.
okay. Yeah, that looked pretty good until I put the other one up.
It's still doing good, but also you're only starting with 20,000 versus the green portfolio or the green line that was starting with 200,000. So a little bit of a difference, but they also have the semiconductor, the green portfolio that has some of the same symbols as budget gourmet. It's just that budget gourmet, I was only picking the symbols out of the entire list that had, like I said, was under $40 a share, just to try a couple small portfolios as well.
Yeah.
And I believe the symbol count is a little less. I believe maybe 17. It's right there. Like.
All right. So let's take a look at the builds then. So what we want to do. Oh, you know what? I can't look at them. I'm gonna have to clone it. So this is the beauty of. So these are portfolios that Jason built. So all I have to do is clone this portfolio. So we'll clone this one. What this will do is it will make it so that I can actually look at the settings. I can control things. You see it turn to purple here, and it's rerunning this strategy in a format that now, when it's done, it will give me the ability which to edit it. And right now, with this, because Jason built it, I can view it, but I can't do it. Now it's built, so now I can go in here and edit portfolio, and it will bring up the portfolio wizard. So we can look at some of the construction of what was done. And Jay, I also want you to talk a little bit about stock selection within this and things of that sort that you did.
Yeah, what I did, the difference was I had received two different spreadsheets, and on one of them it was more of the semiconductor strat, or at least that's what I titled it. I think that's exactly, the semiconductor strategy was the first spreadsheet that I got, and there's still some more symbols on there that I haven't been able to test yet. I just need a little more time to work on some more of that.
Especially since I gave it to you this morning.
Right. It's like, here, do all these. Come on, quick. Get ready for the
you're pretty fast. So we look at the settings. So one of the things that we talk a lot about on the settings, folks, is the ability for you to determine how the capital is being used. Now, we built these on, when you're building portfolios in Wavetech or in Portfolio Expert, in Wavetech, you can only build capital demand models, and you don't have a choice which to do some of the more power user things that you can do on the next level with PX. That's our short for Portfolio Expert. We get tired. That's a lot of syllables. So
it's a lot to say.
Yeah. So what we usually suggest, and we used to go to, with our institutional clients, we usually talk to them about utilizing a moderate activity setting versus the high activity. And we've actually went away from that we started moving that way for a while, actually, and it had a lot to do with some of the stuff that Jay did in his research and building, because he called me up and said, hey, you got to check out the stuff I did. And I'm looking at it like, whoa, what'd you do? And
so I think it was like three or 4 years ago.
Yeah, it was. And I'm like, okay, I got to pay attention, So
because originally, I'm sorry to talk.
No, go ahead.
In Wavetech, some of the guidelines when you're building a portfolio was saying, okay, if you're building mutual fund strategies, you want to go with the high activity, low liquidity setting. But if it's stocks and regular equity symbols, stick with the moderate. And as I was testing all that out, you're just missing out on a lot of profits if you stuck with the moderate setting.
Yeah.
So I started playing around with the high activity, and it just the profits were astoundingly better.
Yeah, and if you folks have been around, Jay and I were talking about this earlier this morning. If you've been around for a while, you've heard me talk about this dynamic profit harvesting. And the reason why this setting works better, makes more money, there's more trading involved in keeping it up to, up in sync with what the models are telling you to do. But it generates a lot of profit taking when the markets are going up. And the way that the modeling process works, if we were to bring up an individual stock, it actually, you're never going to buy the low and sell the high. I saw a troll on the channel this morning and said, my models are 1 day behind. I just thought that was awesome. So I got to figure that model out that tells me what's going to happen exactly tomorrow. But, the way that we're modeling these stocks and things that are going on from the standpoint of the modeling process that the portfolio process is interacting with is, it's trying to find that 60-80% middle of trends. And this, at the moment, is a long-only process. We don't have any shorts. Our institutional clients never really were going to embrace going short, because most of them are investment advisors that we've worked with, and going short is almost like cursing in church. It's just not a good thing to do. And so, but this setting is important to get to that profit harvesting, and there's a lot of other things you can do. And I think, I think Jason, your story is actually pretty amazing, because he was sitting there, didn't have a lot to do and it was kind of a boring time, whatever you want to call it. And he started playing and investigating. Go, hey, I'm going to tweak this, tweak that, and he found out things that nobody else knew by going in and doing it. So you folks have this sandbox to play in, use it. So transaction fees should be nil, even if you're on the institutional side. If you don't have a custodian that's not charging you tickets, you need a new custodian. Management fees for advisors only. So this is a multivariant. I wish I could can I make this? Hang on.
Actually, this one is not a multivariant. I didn't get to that yet on the Budget Gourmet. I did not get a multi.
Well, I'm looking at daily, weekly signals here.
Well, it's a mix of the two.
Oh, I see. You didn't run it. Okay. All right.
I didn't do a duplicate and do both daily and it just selected the best out of the. Yeah.
I got it. So we're gonna do that here in a minute. So I'll pick on this is the Budget Gourmet we're on. Is that what we're on? Yeah. So right. Yeah. So these are all the symbols that came into this, and we built. It's got 18 symbols in there, and then the next step on the wizard is actually determining what type of allocation factor. Now, it's using. Where'd you come up with this 14?
I added the 5. I try to set because it's a fluff statement. If I say, okay, just beef up the number, and clients don't understand what the number is. So if I say that, it could be anything, and then they start getting into trouble. So what I try to say is I add a 0.05 to whatever the number. So if the recommended, like on there, was 0.09, I added 5 to the 9 and got 14.
Got it.
And I usually, I personally will go a little higher at times, but I understand the process better. So I just try to say don't go any higher than 0.5.
So let's unpack that a little bit. What the effects are going to be if you do this, it's going to increase the number of trades that are going to be involved in staying in sync with the models. And what those of you that maybe are new, or maybe you're looking at this platform, what this process does, it's like having, this crazy portfolio manager that knows how to allocate assets out, and he doesn't care about trading, he doesn't care about any of this stuff. It's all non-emotional type transactions that are happening. So when you crank up something like this, we'll show you here in a minute that we'll be hitting this allocation factor. So yeah, Jay, I think what I'll do is I'll take one of your weekly only, and I'll just take it and we'll turn it into a multivariant. We'll just do that here in a minute. So anyway, but this is when you're building these things. This was built. I'm going to go back a couple of spaces. When Jay built this, I take it, Jay, you optimized daily, weekly?
Yeah, correct. Yeah, okay. I did, yeah.
Yeah, so he picked this choice right here. So you have a choice. So when it says optimize, let's talk about that. What the optimization actually does is picks the best model for that symbol. So we have 16,400 plus symbols in our database, and it figures out which has got the best total net profit, and it will put that symbol, it'll attach the model to the symbol. So when you look at the trading system list here, it'll have 1-2 weekly, 3-2 daily. So he just said, hey, show me the best model. Don't care if it's daily or weekly. And you could even optimize it next level and go daily, weekly, monthly, because you can actually do a secular chart here as far as that goes. So there's no problem there with being able to, look at these trades, and you're trading some on a short-term basis, some on a long-term. As soon as we finish this, I'm going to pick a random portfolio here, and I'm going to show you what it looks like as it is built right now, and then we'll kick it into a multivariant, and we'll talk about some of those aspects as well. But I believe that as we go forward, even though some of these stocks have already moved a lot, there's going to be a lot of money in there. And as I mentioned, and as we were all hanging out there for a few minutes, as I mentioned, is I've had a really good track record of looking forward and figuring things out. And some of these things happened in 80, some happened in 2000, and 2009 and 10. The automation theme was just starting to come in. There was a lot of opportunities when that came in, so that happened from that standpoint. So we're really looking at trying to capitalize on movements, cash flow. I've always said that my job has always been a cash flow situation. That if money's coming out of somewhere, where is it going? If it's coming out of bonds, is it going into the stock market? Is it just going under the mattress, or is it going to find a place to be invested? And money wants to go to where the cash flow is. And so that's always been what I've perceived our job as investors, to find out where the cash flow is going. So so we'll just finish this one. So I didn't change anything, so nothing ran. And it looks like, is this the same portfolio, only weekly only, Jay?
Yes, it is.
Okay, so this is perfect. So I clicked on this next portfolio here, and it was the same one we were just looking at, but it's weekly only. In fact, let's compare the two. So weekly only didn't do anywhere close to what the daily weekly did. So what I'm going to do is take this weekly only, I'm going to clone the portfolio, and I'm going to call this an MV daily weekly. So I'm going to take this and make it a multivariant. I'm going to use daily and weekly models to do this. So this will bring you in. So I've got to clone it first. It'll pop up here. There it is. So now you see, and if you're a PX user and you do get somebody else's portfolio, or you can even go in and look at some of our premiers if you want to rebuild those, some of our pre-builts. All you have to do is clone them, and then you own them, and you can change everything in there if you want. So you maybe look at our pre-built and say, you know what, I wouldn't have those stocks in. I'd rather have these. So you could take the core of what the work that we already did and go in there and clone it and be able to change it. So in this case, what I want to do, I need to get my active symbols. So I've clicked on that there, and down below here, my active symbols, all I have to do is click on the Excel button, and it's going to give me these symbols. So these are all the tickers right here. I'm just going to highlight them and copy them. And I'm going to reduce this sheet. And so now what I'm going to do is I'm going to go in here and I'm going to modify. So let's say you were building, let's talk about construction. I'm building a portfolio right now, and I've got the I've got it weekly only. So now I want to take it to the next level, and I'm going to go to Edit Portfolio then, and I'm going to leave all my settings just like they were, and we'll be able to compare all three of these. We'll be able to compare finding the best of breed short-term intermediate. We'll find one just weekly only models, and then we're going to do the MB where this is going to duplicate, and I'll explain this here in a minute. So we're going to keep all the settings the same as they are. Be interesting that I chose one with 20,000 to do this with, Jay.
Yeah, you could change that, or you can go to like the semiconductor strat.
No, that's okay. I'm too deep in this one, so we'll see what happens. There's not that many symbols. I shouldn't run out of money. Okay, so there is a possibility that you could run out of capital if you put enough in there. So here we are drilling through here, and this is where we want to ultimately get to. So we look at our constituent list right now, and what we see here is the list of all the weekly, what the symbols are, and they're weekly. Now, if you remember, I opened the spreadsheet. I'm going to paste those in this symbol entry box, but this time I'm going to optimize them daily. And when I hit add symbols, you'll see this list expand. You'll see the same symbol in there twice. So there we go. So now we've got 36 symbols. We did have 18, but we have the same symbol. So AEHR is 1-2 weekly, 1-2 daily. AMKR 1-2 weekly, 3-2 daily. So it's found the best models on these, on all of them. And so I've taken, and now we're going to do something that I think discovered this shortly after we built this platform, is I'm going to trade these stocks on a short-term and an intermediate level. So I know there's questions out there, well, what if the dailies aren't doing as good as the weeklies are in that period of time? What's going to happen by trading these things twice is you get into that dynamic harvesting tool, which is going to cause different types of transactions to occur. And when that happens, you can still benefit from having those short-term trades come in and out, even though some of them might not be profitable. They may not lose much, but what they can do is trigger the harvesting tool to kick in. So you have two basic processes going on. You have the tool, which is the buy and sell module, and then you have the portfolio module, which is determining exactly how much of the money to allocate out by that model, especially when you have dual models in here, daily and weekly. It's going to have to allocate money out because we've told it there is a way in the system, I'm not going to go through that today, that you can go on margin and go on and leverage these strategies. But this is simply just sticking with, I don't want to use more than 100% of my cash. It's going to rebalance and do things to make sure you never spend more than the money that you have. And so we've got all the models in there twice. And now when we click this time, the recommended with all of the symbols is in point. See if I can highlight this. I don't know if it'll allow me. It won't. So let me draw it in so we make sure that you see exactly what I'm looking at here. So this value right here is what's recommended because we doubled the stocks. The old value was 0.0955. That was the allocation factor. So if we applied Jason's rule, we would go to, 1.0, but I'm going to stick with the 0.5, and the reason for it is we're already at 1.0 because we have twice as many symbols. So when both symbols, when the daily and weekly are long at the same time, you're going to double up on the thing. So I'm going to just decide to stick on it, and then we'll go back and maybe we'll add something to it and see if that does anything. But we're going to get a really good idea of what this multivariant is going to look like. So we're going to click on this, use recommended, and now you'll see in the allocation factor right here, it's now got that 0.52. So I'm done. So I'm finishing. You'll see this thing turn purple here in a second. Actually, it ran. We hit it just right. So we'll see what we just did. So our multivariant is only up, this is interesting, is up 28% this year. The weekly only is up 39. And so here's what this looks like. The blue line, let's see which is which. Yeah, so the green line is actually the multivariant. So while it looks like it's not as much this year, overall it's done even better. I get that right, Jay? Yeah, right? Yeah.
I think so.
Yeah. Make sure I didn't invert it. I am just.
No, you got it all good.
Yeah. So. Yes. Go ahead.
Okay. So this is a second approach then. So is this approach better than throwing in a chosen list of symbols and then letting the multivariate daily, weekly choose which model best suits a particular symbol? Is this doubling up better than that?
Yeah, I think it is, because it can be, and the reason for it, and this is, I haven't figured out how to graphically define this. Who was asking that question? Steve?
Yeah.
Yeah. Yeah, so this, I've been struggling with this for years. So the reason why is and we'll look at some of the stats here in a minute, and I think this is a really good question, because when you split it up, this is why I said I'm going to leave the allocation factor at that 0.05, because I'm trading that same symbol. When they're both long, I'm adding double the allocation. So I'm getting the same symbol, buying and selling it on different time increments and different trends. So we're looking at short-term trends and we're looking at intermediate trends. So the best way to look at it, intermediate trend is going to stand, we're just going to round it off, say 200 plus days, and the short-term trends are going to be 35, 40 days. So you're going to have these trades that come in and double down on that symbol, and then when the short-term starts to top out, it'll back off, and the intermediate will stay on. And so you're getting these ebbs and flows of doubling down and half-sizing the bet during different points in time. And also by doing by doubling down by doubling down on the bets, you're now potentially triggering that harvesting tool. And that's why it ends up to be better, because if I have your question right, the difference between just doing what Jay did is this is comparing weekly. Jay, do we have that? We do have the daily, weekly right here, right?
Correct.
Uh-oh, here we go. Who won?
Who won? The blue.
The blue won. So
the daily, weekly mix.
Yeah, so the daily, weekly mix. So I have to retract everything I just said, Steve. But typically the multivariant will do better. In this case, it did not. The blue line, this is the beauty of this platform, is that you get to figure this out, right? And which are going to be the best. Now, do you really, the tough part here is something I've talked a lot about in the construction of these portfolios. So someone look at this, well, this thing's up 320%, and we are at all-time new highs, right? So this thing should be printing highs as well if you built a good strategy. So what's going to happen though is at some stage markets will go flat and sideways. We keep thinking one day there'll be a correction. We did have almost an 8% correction, and 10, and I think the plus in the in the NASDAQ recently. But these things happen really fast right now. But anyway, the point is that what's going to happen is when the intermediate charts start to roll over, the daily charts are rolling over, this is going to put you in cash and protect the assets as you go forward. So that's really the edge that you're going to get on doing the multivariate. You won't have the exact same edge. What we almost need to look at is to look at some of the volatility in the different strategies. So like if we went into maybe, and this isn't going to happen very quick, real time. It would take some analysis, but we need to look at maybe rolling return volatility. This 24-month rolling return. Start to look at what really. That goes to what I was saying earlier. What is the attribute you're trying? Are you looking at the best returns with the lowest possibility in volatility, or you just don't care about volatility? You just want to make money. So one of the things that you can do also is to have multiple households. And I know that I've talked to a number of folks where you can set up multiple accounts. So you have a household account, A, B, C, and D, and you can put different strategies in those. So in the investment world and advisor world, they talk about sleeves, and so you would build sleeves and you would allocate a certain amount of money out to some of these things. So you might build a portfolio that has high volatility, but also has really high returns, and maybe you allocate less to that as something to add alpha to the overall household that you're trying to manage. And and the beauty is you can actually do these strategies no matter if you don't have to have a lot of money to do this anymore because of fractional shares. You can actually do a micro version of this entire strategy. This used to be impossible. Over the years, for the last 20 some odd years dealing with institutions, what we found is we talk to our clients, our institutional clients, about, well, you probably need to have $250,000 or $500,000 in, with the customer to be able to do these multiple strategies. Well, that's all out the window now. You can do that same probably multiple strategy with 20 or 50, and like Jay was building these with $20,000. So and you're looking at, when we put some of these multivariants up here, you're looking at returns over since 2015 of 200%, and just on basically trading between 18 stocks and doing a multivariant. So I don't know if I answered your question or not, Steve, but that's kind of the unpacking of that.
No, that's good, thanks. I'm just trying to figure out what was the best approach. It looks like if I take the approach of doing the complete doubling up, that there's going to be a lot more trading involved, and there's more simplicity in just letting it optimize daily, weekly, and choosing which model goes for a symbol. And then I would just offset that by putting in, for the weekly stocks, I would just put in a stop, not a trailing stop, because I think that'll screw things up, but in terms of syncing with your model. But for me, not losing any more than 8% from the original purchase price is something I had put in for the weekly models, and then just monitor from there and reconcile from there. So I'm not sure what the best approach is. I don't want to be spending all my time watching the computer on the daily thing. So I think if I just put in fairly loose stops just on the original purchase price for the weekly, that should suffice, I hope. What do you think about that?
Yeah, no, I think that can. And see, listen, this is the thing. This is a completely customizable platform. Most of the things, anything, when you say portfolio, you end up with these garbage packaged products on Wall Street, ETFs and that stuff. I mean, they can work, but there's one of my mentors used to always say, he goes, you can make money with me. There weren't even, when he said this, there weren't even ETFs, didn't even exist. But he said, you make money in mutual funds, but you'll never get rich. And the only way you can make some real money in the markets is individual stocks, having a good strategy, and kind of the evolution going back He said that to me about 1985, so a long time ago when I heard those words. And you just kind of over the course of time and building these products and getting more dynamic and being able to look at things in depth like this and take these strategies and see what they could do in this sandbox. And it ultimately comes down to the types of things you have time for, what you want, what kind goes to that volatility. You have to define. I'm trying to find this old presentation, and if I find it, I have to morph it into current, but it really comes down to defining everything about what you're trying to do. So I used to tell folks to take the strategy, like what you're designing and what you're talking about, Steve, is write down a statement, what you're trying to achieve with, and then start to track that thing and make different updates from the standpoint of, journal. And I haven't had a chance to use it yet, but I'm going to spend some time over the next couple of days with a product that allows you to journal and to do some other analysis of all the trades. I think it's going to be potentially a game changer for understanding even our process at the next level. And I'll let you folks know when I figure that out. I haven't figured it out yet, but it looks promising anyway. But hopefully, when you're designing these things, you need to take those considerations. I don't want to sit in front of a screen all day. Some people do, and others don't. And, you try to simplify, get the best returns for what you're trying to do. And ultimately, my plan is to get this to be a robot, and you just set it up and say, do the trades for me. You won't even need to be there. That's my goal. And, I've been talking about this for a little while, but the realities are much closer. We've got a partner that I'm trying to work with right now to be able to completely one click automate, do the trades, everything happens. It'd be on the PX side only, but that's my goal, is to be able to automate the trading, and all you do is monitor it. You have a dashboard and look at your different strategies, maybe the household, and you can hook all the pieces together. That's really, I think, the key.
So in what you just showed us, the multivariant, I think, didn't do as well as the mixed strategy where you have a single stock. The system choose which model it's going to use, correct?
That on this particular example, yeah, I've seen it the opposite.
Right.
It's not.
I think let me interject something real quick, because I believe part of what happened was on the regular strategy, it was actually the real whiz strategy, which isn't fair because the allocation factor was beefed up. So it's going to have a better performance anyway.
My question is, if you see that, let's say you do a back test and you see that the multivariant isn't doing as well, is there an easy way, or a relatively easy way, with this PX system to see the charts of a set of stocks? Like, I was thinking, in my experience, that kind of thing would happen if I had a stock or two in there that has been really not doing well in the daily model, let's say.
Right.
It's been just out of sync with the daily model. So if I could spot that stock and then create a multivariant portfolio, but have that particular stock in there only on a weekly, monthly, let's say. So what I'm looking for, is there a way to troubleshoot what happened with the multivariant so that I can adjust it and not just abandon multivariant?
Right. Yeah, this is the thing about being able to build a custom product, right? And figuring these things out. That's why we built the platform. And there's no, we've already seen things from the field, guys like you, John, and others that are figuring out, hey, if I do this, this is better than that, And, we've got a lot of brain power out there rather than, and matter of fact, Jay's taken a lot of my ideas and went well beyond, what I've done as well, so I end up running companies and doing other things, and Jay's become the Portfolio Expert. So that's the first thing I did this morning. Hey, can you build this stuff? I can build it, but it just takes a lot of time, and I don't have the time at the moment. So,
Well, one way I can see that doing this troubleshooting would be doable is I just take the portfolio in question, split it in half, take half the symbols, and and then basically kind of search down to which set of stocks seems to do worse in the multivariate, and then by that kind of fine tune the portfolio. I'm just wondering if that's a time consuming thing. I'm just wondering if it's a better way to do that kind of thing.
yeah, yeah, it's kind of yeah. I don't know, John. Jay, do you have any thoughts on that?
Yeah, I was trying to figure that out myself. One of the things is when you go to the portfolio symbol return page, that at least overall that gives you the profit and loss that each of the symbols made in the portfolio itself, and maybe if trying to, it'll show you right there which ones didn't perform as well, and if it was on a daily or a weekly model, and maybe you can just see which ones really in the past didn't perform well. I don't know, that may help.
Well,
That sounds like would help. Yeah.
Michael, I think it's worth mentioning the way where you actually run individual symbol on all the models to determine which model have the overall best results for an individual symbol.
Oh, hi, Michael. It's Wayne. Yeah, one of the things I did, if I wasn't sure on a particular model, I built a portfolio with a single stock and put in the 2 dailies and the 2 weeklies, and then ran the model based on one lot with daily, one lot with weekly, one lot with 3.2 daily, and one lot with 3.2 weekly, and then compared them and looked at them, and you could see which model for that stock worked the best if I wasn't sure. And sometimes I would then I'd select the most appropriate model using that method. And that worked well.
Yeah. Yeah. So Wayne, you showed me that, and it was pretty impressive.
Wait,
Yes,
is that in Wavetech or PX?
in PX.
Yeah, there's so much more flexibility on the PX platform. It's just, it's amazing.
But I don't see why can't you do that in Wavetech either. I think you could do it in Wavetech as well. I've never tried it in Wavetech, but I don't see why can't you do it in Wavetech.
Well, you can only put one symbol on one model at a time. I guess you could run multiple models and get to that point, right? Multiple portfolios.
Yeah, if you
Yeah,
did that,
yeah, you
you'd
have to do it that way.
Yeah, so we don't let we don't let that go. So you can only allow one symbol at a time in Wavetech, where PX can do the same symbol. Like Wayne was suggesting, you could put when Wayne and I talked a couple of weeks ago, he was saying that actually have been put each model, so 1, 2, 3, 2 daily, 1, 2, 3, 2 weekly, and put all of them on there, and it did amazing. But it's a lot of trades. Definitely a lot of trades to do something like that. So okay, so a few questions came up on that. Just trying to look at. I want to keep this meeting down to. We'll probably just keep going with the questions right now. If you folks have some stuff, I think John. I think early on about the ETS, maybe you want to bring that back up.
Yeah, Bob. The ETFs?
Yeah. What was your construction on how you were structuring that?
Well, what I did was I took a good ETF, for instance, PAVE, I think I used PAVE, and I looked at the portfolio. I think there was 100 stocks in that particular ETF, and then it was broken down by industry. So within each industry, I was able to set up those stocks so which were the most profitable. And those that were most profitable within that portfolio, I then went to a Reuters analysis and read a little bit about that and determined whether or not stock would be suitable
Okay.
in my portfolio.
Okay. Yeah.
And that was based on profit. I also used Schwab rating. I picked all A-rated stocks, which were the top stocks, and and then looked at the profitability of each one, and then put them in my portfolio, and then back tested it back to 2016. So I don't know if that's the right thing to do, but the energy one was let's see what I have here. It was like 14, 14 active stocks based on a $100,000 portfolio. Uh, 36% on the back test. No, I just did it the other day.
Yeah.
I try to watch it a little bit today, but I don't have all the numbers together here.
Okay. Yeah, I mean that's basically a process. Jay, you have any other thoughts? Because Jay actually goes in. He's got a whole process that he goes through step by step. That's pretty much it, right, Jay?
Can you hear me? It wasn't unmuting.
Yeah. Now you're okay.
Okay. Yeah, and I do have some of the live shows, some of the previous live shows that we've done. I've been able to edit some to where instead of a 2.5 hour show like Bob was talking about earlier, and you're trying to sift through, I've actually narrowed them down to where it's precise and to the point of the topic we're teaching, and it's usually about hour 15 minutes. I've cut it in half, but on some of that, yeah, we've gone into detail, and that is exactly some of what we're doing. But yeah, I've gone into detail on exactly, you know, how you pick those from the ETF and just really see if they can work. Sorry, I was trying to multitask when you
Yeah.
were going over some of that stuff.
Yeah, there's a conversation going on with David and Danny over on YouTube that, you know, folks are asking if you guys are making any money using this product. So maybe somebody want to just tell us all a little bit about that, because I think that's a question. It's a valid question to ask, and because of you know, we don't, as you folks know, this entire platform is customizable to you, and that's why we're talking about researching, looking at symbols, digging in deep, and you know, there are effective ways to manage money, and I think I know we've talked about it, but like I said, it's buried in 40 hours of live streams, right? And but just taking a look at, you know, you always have control of when you get in and out of a stock, because you can always go in and just turn it off and make that happen there. So you can go from there. I'm actually going to log out of this account that I'm in over here. I just realized I always do this because I only know the login on one. Everything else is saved. So I'm going to bring up another browser. But yeah, so that ETF ETF-DB is a good one. You can get all the constituents. You can dig through these. And my argument with ETF hacking is finding exactly what folks, you know, what these institutions and people that are running, whether it's people like ARK or other ETFs that are actively managed, they're spending a lot of time thinking about what to own. So take advantage of all the hard work and money that they're spending on research and getting the transparency and finding these stocks and then getting them down into the models and finding the best models. And so one of the questions that I think, you know, a lot of folks always are asking, well, you know, that's why we have, like on individual symbols, we have the ER ratios, and which tells you how effective it is on every symbol, all 16,400 symbols. So your favorite symbol, you may have a favorite, it may not trade that symbol very well. For whatever reason, the modeling techniques that are in there may not work. And so I always say there's 16,000 symbols, find the ones that work. And I know that a group of us that, you know, have worked on this thing for years and trying to use, there's a query tool in the PX, and there's a query tool in Wavetech as well. And you can go in and query the database and find the symbols that do the best. Most of you guys know that, I suspect.
So Bob, I wanted to answer the question on whether the software makes money or not.
Okay, go ahead.
So from my experience, and I'm sure it could be confirmed at least by couple more people, the software, like with the help of the software, I'm already up about 30% from the beginning of the year. And I think very important point to make is not only the software helps to make money, but like you always mention, it helps you to basically stop the bleeding or sit out of the moments where you don't actually need to be in. So like, for example, right now, I'm not actively trading because based on what software shows to me, there is no clear direction. So I'm basically satisfied with my current results and basically just sitting out right now. And the software helps me with that, basically to know when it's the right moment to not be trading, actively involved and actively invested. And I also have pretty good results over the past year. And I think that even though I was only learning, I made pretty good results over the past year, well over 50% return. But having said that, I also believe that there is a learning curve. It took me about 3 to 4 months to understand how the software works and to make it helpful and useful in terms of my investing decision making process.
Right.
So hopefully that was helpful to whoever's considering the software.
Yeah. So I see Mr. Tater. I thought he was on the. Just a question on YouTube, real quick. So, yeah, the sell signal will show up. The icon will show up in a watch list if there's a sell. Absolutely.
You know, another advantage to the Wavetech, Bob, from my point of view anyway, gets you away from the emotional trading. For instance, before Wavetech, when I had a stock or other stocks, I'd trade on emotion, you know, fear, listening to everything that's going on in the market, all the static, and, you know, this is going up, that's going down, and I'd get out of a stock too soon or too late. And with the Wavetech, I just let it ride. Whatever Wavetech tells me, that's what I do. So, I mean, that's one of the great benefits of this.
Yeah.
Is that, you know, you don't have the emotion involved in, you know, trading on your own.
Yeah, that was the original premise of building it in 1998 was that. Yeah, so, but no, that is the goal, is to eliminate those things. The other thing is to be able to watch way more moving targets than you could normally. There's a lot of stuff when you get into these more complex structured portfolios. It just is, you and I as a human being couldn't process all that and follow them and look at it technically and decide to buy and sell and things like that. You could on a very small subset, you know, small set of symbols, but it would be very difficult for you to be able to pull that off on a larger scale. So that was, yeah, that's something that, you know, that was the goal, and it's been achieved. I know there's a couple folks that I see who's on the channel yet, but there's people that have been around for tens of years. I think Corey, I don't know if he's still around, but if he's on the still on the meeting, I think I met him in 2003, and he's been running. He's an institutional client, been around for a long time, and that's always been what we've been out to do, is to get this, you know, get the emotion out of the game, and that's really the goal, and to be able to manage money over time. You know, it takes. I think Michael's comment was pretty valid. It takes a while to come into a modeling process. You know, it's not a short-term trading model, and even the daily models, you know, it's 2 or 3 months, and we've always told institutional clients that you've got to go through probably a 2-year period and in modeling stocks. Now, in the world we live in now, and especially after 2020 and the last look back in the last 12 months, you know, market expectations have been expanded quite a bit. So people now think you're just always going to make, you know, it used to be institutional side, if you made 6-8% compound every year, you were a hero. Now people are going, I made 10% yesterday. So the expectations for returns have went up. And in this type of environment, when you're trying to run a basket of stocks, you're basically building, and that's why we talk about the ETFs, you're building your own mutual funds. And when you start to do that, you have two effects. One, you're not going to make the same amount of money if you're just trading one stock or small 5 or 6 things. You're going to be able to make a lot bigger returns. But when you start to manage more serious money and you get into, you know, literally, you know, billions of dollars being managed, you can't run money like you do as an individual with 100,000. But that same concept is valuable over a long term, because one of the things that I want to help people the most is retirement money. And I, you know, if we can show you how to make that nice return and control the downside, get rid of the emotions. That's really the goal. And like I said, I really want to get this thing 100% automated at some stage.
Hey, Bob, this is Marilyn. Could I ask a question?
Please, please.
Okay, so I've been listening to you since probably July this past year, and then I just joined Wavetech end of January, and just, started buying into some symbols a few weeks ago. And the challenge of, let's say I did the back testing and thought I had a pretty good portfolio, and year to date should be about 30% or so. But the challenge of jumping in when I did, and I, was trying to work on that 30-30 rule, and trying to figure out how to get in, when to get in. And I was questioning, Jay, in terms of some of the, like a, moving average, because some of the symbols, even though they were less than 30% in, it seemed like they were kind of high. And so I felt like I sort of guessed wrong, because I bought into some of them, and then of course within a week or two they tanked, and then it took 2 days before Wavetech said to sell. And since I only bought in and they told to sell, I mean, took losses on most of the symbols.
Right.
And so it was a rough start. And,
Yeah, no, and that's one of the things we've always cautioned about, Marilyn, is trying to come in these stocks that have already moved, and it's not just 30% holding, but it's also looking at the expected return. So I don't know what that looked like at the time, but a lot of times when you get symbols that are in, you're buying risk. Jay and I were. That's one of the dangers of back testing, looking at current values and trying to figure out how to enter in. And we've seen all kinds of concepts and ideas like, well, I'm going to wait to the brand new signals. So that's not a bad idea, but you end up sitting around in cash depending on where you are in the market cycle. That's something that happens a lot. So you're not making any money, but you're not losing any waiting for new signals. Were these daily models that you were coming into?
some were daily, some were weekly.
Yeah, so if you would reach out to us, I wouldn't mind taking a look and see what was going on there, and maybe chat something off of, not on the internet about this. I'd be glad to take a look at that. So send us an email, and Jay or I will get back to you and just kind of look at and see what happened there. But that's the tough part, especially when these markets are running and we're all-time highs. We did see that short-term database pull back all the way to about maybe 16% bullish, and so that dumped out. Now those are coming back in, and so the hard part also off of that type of start is when they tell you to get back in, to come back in. Those are hard trades. And
would you advise, if you were starting out a portfolio, to make sure that let's say all your symbols are in varying sectors, so you're not all into just a couple sectors?
Yeah, Jay has been the master. I'm going to let him step into that, because he's been the master of these motifs, which are highly concentrated in one thought. So we're transportation, or Jay, why don't you address what you've done with those motifs and some of the risks I know we've seen in that, especially coming in after symbols are already long and the signal's already on.
Yeah, some of it just, I don't, trying to think of how to address that, but I mean, yeah, some of the motifs that weren't doing real good last year have come on strong this year, and some of it's the different industries that are needed and stuff. And some of that. Yeah, I'm trying to think of how to even answer. Because I've been trying to go back and see how a lot of the other motifs are doing, because they're so focused.
That's not what I'm talking about here.
Oh,
what I'm talking about is when you're constructing them, the way that you're, I guess, Marilyn, the answer here is that you're going to make, when you concentrate like that, if you've picked the right industry, right, then you're going to really, it's going to really roll. You're going to make a lot of money. If you look at like the pre-builts and look at these motifs, anything that says motif in it, there's some big returns, but there's also big volatility because you're concentrated. And so there is a benefit of diversifying across, and that's some of these. If you look at every ETF that's built out on Wall Street, they all look basically the same. They have a bet, like I've dug into ARK investments, right? So Kathy Wood, they do the same thing as all of the active managers and ETFs. They have a subset of stocks between 5 and 10 where they make heavy bets, and then everything under that you'll see 1.5%, 1%. The top bets are maybe, I think in ARK Innovation at one stage it was, Tesla was 7% of the bet, and so in the top 10 was almost 50% of the concentration, and then everything below it was what I call pie filler. They just need something so when you're buying the ETF, they can balance out with those stocks. So those stocks also act sometimes as a balancer. And when you're looking at like building something in Wavetech or PX, what happens is you can get too diversified. It has a lot to do with the money that you have, but it's not a bad idea to look around sectors. I know in just on the YouTube channel, I was talking about the financials, and you know what? And now that I think about it, there's something I wanted to see might be in this portfolio here. Let me do something. And market did close lower. Okay, let me just do something over here. I just don't want the whole world to see my login. There's the hour late bell. It's that time of the year. One second here, folks, and I'll show you what I'm. All right, let me bring this back on here. Yeah, so I just wanted to see there's a portfolio I built. So these are some of the things that, yeah, here it is. This is maybe just using ETFs, but there's something to be said about this. So this was a strategy that I built actually a number of years ago. And all I want to do is participate in the oil market, and I picked some ETFs that I wanted to look at. So I had FXN, here we got Vanguard Energy, we got XLE and XOP. So it's all concentrated, right? And this is on an ETF, so you're running baskets. So depending on, this is important, Marilyn, as trying to define what it is that you're trying to achieve with your strategies and what kind of money and what kind of risks you're taking and all that kind of stuff. So maybe if you want, you could maybe address some of that, and I could do it. But this particular strategy had 4 portfolios in it, and if you look at the bottom here, it did okay. It just kind of hummed along. All of a sudden, energy came in, and back in November and December, I was noticing that we're seeing rotation into, there were 2 things that are happening. The interest rates were starting to go up, and then we were starting to see the big open trade, open economy trade coming back on, and so energy was going to be an obvious place, and financial was another. But I just But this is a concentrated strategy, and you can see over the years, nothing. I built this thing years and years ago. I think it was 2010 or something when I built this. And even if I went 5 years back, it was 2012 or 13 maybe. But it's never, it's been very steady. You can see the volatility. And the advantage of looking back in that, there's something I'm going to show you, everybody here. I just thought of a really good thing to look at when you're looking at a portfolio on entering into the portfolio. So one of the other things you might do, Marilyn, is to take your total money and maybe even downsize a bet until you start to see new trades coming on that are brand new, But one of the things that you can look at on, and if you go to performance here, you'll see something here. I'm just gonna, actually this might be, is that index live? It is not. Okay. So I'm just going to put another index on here just so I can see. But what I want to see here is the rolling 12, the average drawdown, all of this stuff. This is really when you're deciding how to enter into a portfolio you built. You want to go to this performance page and you want to look at the rolling returns. And then you want to look at the average drawdown. So this one has a 3.38% average drawdown. And if I were to look at your portfolio, the first thing I would do would go over here, look at this summary page here, average drawdown, and the DDFI as drawdown from inception. So it's the same in this one. Sometimes this will vary depending on the rolling 12s and all that, but this one is the same. And it also gives you the Sharpe ratio. But what I want to do is go to the summary page. And so let's say I come into this strategy right now. It's got all 4 long. The thing's up 30%. This 30.3% this year. And what I want to figure out is how much risk am I taking? So I'm looking at right now, in 14 days, this thing's been so volatile, it's 5.77% off of its high. And if we go back to this performance page real quick, I'm just going to look at the this 3.88. We've exceeded this average drawdown, and there's a couple other elements. So what that tells us is that there's less risk on an average basis to enter these symbols. So I go over to the open positions, and I take a look at what's open on this thing right now. Open positions are the percent portfolios. This is what's out there. Here's the last price. This is what they've returned. And we could also even go and look at individual durations on these things to see where they are. So I'm just clicking on R button to see if I can get there real quick. So I built this thing, and I want to see where this thing is at right now. It's up 50%. So this one's going to be a tough one, right, to get to, because I'm going to go to my model results and I'm going to look at to see how this thing is, how the returns are. And if I look at this over here, we're looking at the average win, 23%. We're up 40, so we've doubled everything. This portfolio would be pretty tough to come in, even though it's down at below its average drawdown. This would be called I missed it, right? This is probably not one that you want to get into. Jay and I were talking about earlier. I built a crazy short portfolio. I don't think it's in this account. Let me look. And I think it was called Short Opportunities. Let me see. I think it's in a different account that I did that. But the thing was up. Yeah, I don't see it. It's in a different account. But it was up 250% in 1 month. It was all the short sales, the GMEs, all the stuff that was on, short squeeze. I think it was short squeeze opportunity. Oh, there it is. So here it is. I thought it was in this account. So I'll show you this. This is the 219%. and then it lost money in February, gave back a little bit, now it's up a little bit. And this was, we were talking about this, if you were to walk in and build something, this portfolio's probability of increasing that, maybe it'll work, but most of the time you get these weird spikes in values like what we're seeing here, and there's just no way to get involved in that. So the 30-30 rule is going to work, and it's 30, I know I'm kind of rambling on about this particular situation, but it's very difficult when you're at, we go over here to, I just want to put this over, and we go to, I don't want to go there, hang on, I'll get it to the right page, but we look at these indexes, and we're at all-time high, and we're trying to put in new investments at these. It's going to be somewhat risky. The only good thing is, like, since the short-term database is rolled over, there should be a lot of new opportunities out there, and that would be helpful, I think, to watch for that. So I'm not sure. I kind of walked down a rabbit hole, can't find a way out. So, do you have any comments on what I was? You still there, Marilyn? Did I go on so long I lost you? There you are.
Is she still there?
Yeah, I think she's still there. Yeah. Anyway, but yeah, so everybody, that's the hard part, is being very careful when you've got a, when you've got a strategy that's, or you build something and you're back testing and you're trying to come into a middle of a trade. It's always been, like a minefield. One of the things, as long as there's not some crazy returns like this portfolio was, and you can go back and even looking, even at this IS oil portfolio I had, it's got those type of, it was really steady returns, and then all of a sudden you get February is a 21% gain. So that's something that happens, that you have to be careful with when you're looking at any kind of symbol that's already been long for a while. And it looks to me like if I were looking at these ETFs, I would, when we were looking at the oil, that this would just be stay away from this one because it's too far. You can see the spike. What we were talking about earlier is that sometimes you make so much money in 1 month, it's just like go away, go on vacation, come back in 3 months, look for new signals, maybe look for new symbols altogether. So let's do another question. We're about an hour and a half. I want to make sure we complete this. And
hey, Bob, down here.
Yeah.
Got a quick question. How you brought this Wavetech screen into Portfolio Expert? Could you talk me through the steps how to get that internal web browser in there again?
Yeah. So I'm just going to delete it. We'll just take it out altogether. All right. So we go up here, we go into Show View, and right here toward the top, you'll see General Internet Browser. You add it, and there it is. And just like any other browser, you just put in this case, you'll have to put that vpm2.vpm partners. And click that, and there you go.
Wow, okay.
And then what you can do is double click on the tab and make it full screen. I just find that useful. Like I said, I was kind of disappointed. Jay and I were trying to add multiple tabs like this and only let us add one. And I think that's probably something in inside the software, just to allow multiple instances. What would be nice is you could have quotes, or this browser is an old browser that's embedded, so it'll run this old clunky Wavetech, but there's some HTML5 websites it won't run. Like I tried putting TradingView in this window and it wouldn't work, but it just needs an updated browser, and I'm looking to update the browser so you could actually go in here and just put in CNBC. And if you just wanted some quotes and you didn't want to leave anything, of course, I used this the other day. It worked fine. It's a classic. Oh, I know why it's distorted. Yeah, I don't know. Now it's not even working, so it's classic. I was using this the other day. It worked fine. Destroyed Market Watch. Yeah, some sites won't run on this because it's an old embedded browser, but there you go. So I guess if you wanted just some quotes there, and then you can cause the browser to get, you could enlarge it, I guess, if you wanted.
Okay, good. Yeah, because I use, of course, the Wavetech to get the 30% gains out of Wavetech, but you can't get that out of Portfolio Expert, right?
You can. You mean as far as where it's at in its cycle?
Well, yeah, I get duration on PX.
Right.
But as far as the percent.
Oh, yeah, it doesn't show you that, does it?
Yeah, I think that's Wavetech only, but to embed this in here, that brings it all together.
Yeah, I had a big conversation with the guy that designed all this, and we were talking about like a list of stuff. I may query you folks out there, like list of stuff that you would like to have in PX that's not in Portfolio Expert. And I'll admit this on the internet, and this was an oversight of mine several years ago, that I missed some of these things. We were so excited about having all the new capabilities on the portfolio side, we forgot about some of the basics, and that's why I like embedding this, just doing the BPM 2.BPM partners, and
yeah, no, we're fine on mine over here, so
yeah.
I got it.
Yeah, so it's pretty handy, I think. So that at least bridges the gap a little easier without having to go back and forth.
Yeah, no, perfect. Thanks.
So I wanted to answer the question of how it's been doing for me.
Yeah.
So I've only been actively trading about 3 months in it, and what I've noticed is that it doesn't always get, it's not foolproof, definitely, and when I've gone against its recommendations at times, and I've kind of noted when I've gone against its recommendations to see how that actually turned out in the end. And I would say, probably twice as often the system is made a better decision than I would.
Yeah.
And it's that probability that feels like it's the big advantage here. Not that it's going to be right every time. It's just increasing the probability. And what another person mentioned is my fear factor would have kept me out of a lot of things if I hadn't had the tool to kind of back me up and, prompt me to go in.
Right.
So I would say those two factors, increasing the probabilities and moving me past my fear decisions, have been well worth, the cost of the system and so on.
Yeah.
I also want to mention one other thing is that in this last 3 months, what I've kind of adopted is an approach. I'm using PX, and I'm putting stocks from a fairly broad range of sectors, but sectors that I get are likely promising in the near term, like financials and transportation, infrastructure, and then having two portfolios, one that has higher funding per stock and another that has lower funding per stock. So the ones that I'm more confident in are going into the higher funding per stock, and that way I can kind of allocate between these two portfolios which stocks I want to place a stronger bet on. And each portfolio I have multivariate stuff happening, and if I see at any point a stock that seems to be like out of phase with the daily models, then I'll stop it and I'll put that same stock in a portfolio that I don't even trade, just to have an early warning system for that stock. So I don't know what you think of that strategy, but that's what's been working fairly good in the last month for me.
Yeah, well, this is the thing that I have said for, I made this comment, I think, in 1998, is that the best ideas will not come from within. It will come from you folks that are using the product on a day-to-day basis. And like I said, I've learned a lot from the community already, just doing these meetings. I know Jay's been running the meetings for a while. I haven't been in on one, but it's just, yeah, I mean, we learn stuff all the time because of comments like this and, others that are really engaged with the product. And, we've seen a deep engagement by some of the users. I've never seen anything like this. I've got literally people all over the planet that are using the product that are commenting and having success. But part of that, there's a learning curve on everything, and you got 16,400 symbols. It's a giant minefield. You got to be careful, like what Marilyn was talking about. I hope, Marilyn, if you're still around, make sure you send us an email. I would like to look specifically at what you did. And, I think when you see that kind of stuff, when you're out there and there's just so many possibilities in this product, in some ways, there's a lot of folks out there that are just selling packaged products, and here's our 8 portfolios that we believe in, and that's fine. But we always felt that it was going to be much more empowering to give you guys the way to actually, actually do the research and apply it, and then, when you apply it, you learn in the real world, and you lose money, you make money, and you go, well, I'm not going to do that anymore. I used to have a favorite joke. I don't make the same mistake more than 55 times. And, that was probably my first 10 years. That was kind of a joke I always made, because that's just part of learning how to use a product like this. And we try to bridge the gap doing these meetings, trying to do all this stuff, engaging, and we learn, you learn, we all learn together. So it's been great having this community. So anything else, folks?
Bob, this is Jeff. How are you?
Good.
Yeah, I guess I'm my own worst enemy when it comes to trading, so I'm hoping I'm going to be able to use this software to avoid the emotional part of it. And I really haven't stuck with anything yet, even though I've been following along and learning, and I think I've gotten pretty good at the tool and building portfolios, but I haven't really started to invest yet. But I guess what I'm struggling with is just the whole valuation of the market right now. And I'm 60 years old, so I'm getting close to retirement, and I've saved, I got a pretty good nest egg, so when I do invest, it'll be a good chunk of money. And I'm struggling with the valuation of the market today, and and I know that the tool does protect you by getting you out of symbols, but I don't know, is there any benefit in your mind to just waiting for more of a bigger correction to the market and a lower point, or is it best just to jump in and let the tool, from your history, is it better just to jump in even with the market valuations the way they are? And it makes a lot of sense what you're saying about it. It's still trending. It looks like it's got a lot of upside with all the government intervention. It certainly probably does.
Yeah.
But I still look at some other websites that just talk about some of the how historically overvalued we are. And I'm just wondering, is it worth sitting back for a year or two to be able to get in after a big correction, or is it better just to jump in and let the tool?
Well, that's the thing. If that big correction comes, you're going to be out. So I know of the noise out there. I am not a perma bull, but it's really hard to be bearish right now. And that's why when we started this, if you were on at the beginning, and I went through that quick PowerPoint, I'm going to be using that PowerPoint on a video I'm working on. And I think I figured out a big piece of the puzzle the other day. It's been dominating my thought. So I think when you start throwing trillions of dollars into markets, we've already seen what's happened in the last year, and they didn't put anything really. I guess they did throw, we'll say, 4 trillion, but now they're doubling down, and they're probably going to triple down on the stimulus and these packages. They're a long ways from being done, and they're. So I think it would be, I've made this comment on live streams that I think the S&P can go to 10,000, and that just sounds crazy. I remember saying something. I found a white paper and an annual report that I did in, I believe it was 2016. I think I showed it on a live stream one day, and I was talking about the S&P going to 4,100 in 2016, and that seemed ridiculous. And the 23,000, I forget the numbers on the S&P, and I had it's in writing. It's in. So I was just like, I just ran across. I hadn't seen that report for years, and then I ran across that. So one of the dangers, I talk a lot about having a process, and to your point is those folks, their process is trying to find some logical, I guess, valuation, something that's going to tell them. And I always throw this thing out, and I don't know how many, if any of the institutional guys are hanging out. A number of them been around a long time, but I've always talked about process over attitude and opinions. And attitude and opinions keep you out when you should be in, and in when you should be out. And that's what those are. Those are opinions about valuations, and I get that, but I believe we've entered a new era of investing. Me sitting here, for the most part, talking to retail investors was not what I've done ever in my career. Going to have to go back into the 80s when I was doing any kind of real retail of any sort. And I think there really is a retail revolution going on, and I think fractional shares and all this stuff is big. I found in November of 2019, I went to a Charles Schwab conference for institutional, and I remember leaving there, and I did a little podcast. I've threatened to put that out there. It was kind of interesting, but I thought that volume would absolutely explode and would be multiple 4 or 5 times the volume, and that's basically what's happened. We used to do 1.5 billion shares a day, and now there's 6, 8, 10, 12 billion a day. So the participation in the markets are bigger, the cash flows are bigger, everything's bigger, and it drives a lot of these valuations. And too many people try to invest looking in the rearview mirror, and I think that's what that is that's a good way to keep out. So I would find symbols that are in good cycles, new, like what we're seeing right now, and that's why I cover the database every night in the daily videos. Those videos are meant for you folks on the call, on the Zoom call, because this is exactly understanding the software, the rotations that are happening, short-term, intermediate, are really important, and the intermediate trends are still very much. There's probably at least another 3, 4, 6 months. It'd probably carry us into fourth quarter by the time we're really getting frothy, and and the short term is going to migrate in and out multiple times during that same, during that stretch, right? So between now and November, we'll probably see the short-term database get 60, 80+% bullish, rotate back down to 20, 30, whatever, and then do it again before we hit the final top of this particular sequence. And so I think building good quality portfolios, whether it's going in and digging through ETFs or finding some concepts of things that you're doing, that's where you want to focus. So, I'd say keep doing the homework. Make sure you reach out, come to these meetings, ask questions like you're doing, and try to, we'll try to address these things as they come up, because I think you're not the only one.
Hey, Bob, just a quick question if I could.
Did I lose you?
Sorry, my mic went off there. I'll just turn it on for a second. So I've got a question about the symbol trade profile.
Yeah.
There's a term called projected max days.
Yeah.
And it tries to determine if it's a good time to buy a stock.
Yeah.
Under PX is where I'm talking about, but it's probably in Wavetech too.
It is.
But it's.
Do you have a symbol in mind?
Yeah. AVGO, Broadcom.
ADGO?
Albert Victor George Oscar.
Got it.
And so on that symbol trade profile,
Oscar, hang on, I fat fingered it. Now I don't even know.
Yeah, AVGO. Albert.
Yep.
Vertigo.
Got it.
Go. The symbol trade profile shows this term called projected max days. Like there's the max days held, which is 420, right?
Yep.
And then there's the. So I'm just trying to understand, just make sure that I'm interpreting these terms properly.
Yeah. So so let me just refresh this page so it'll size properly. Okay. So what we're talking about here is the current trade is 100 of 194, right? A P&L is 22%. The average P&L on this is 33, which would suggest it would go to 518. And then your question here is on which? On the mean?
Well, actually, under PX, there's a symbol trade profile that you can bring up by going, the show window or show like that window you bring up where you can choose from different different profiles coming up, or not profiles, but different aspects that you can show.
And this is a weekly model, right?
Yeah. So one's called symbol trade profile, and so it's clear what max days held is. It's clear what current duration is, but then you've got this term in there called projected max days. So it sounds like there's a reinterpretation saying, hey, max days are usually 420, but this time we're projecting 250. And so I'm just a little unclear about that.
Okay, so so the projected projected max days, it's right here. I know that might be a little small, and I can't make it bigger in this platform, but the projected, so it's max days held, but what they're saying is it's taking the standard deviation plus that is what it's saying here. The current duration is 100, projected is 250. So it's just it's extrapolating out this range as far as where it's likely to be held to.
Oh, I see. Okay, so then the max days held is still 420. So the difference between the two.
Yeah. So max days held is historical, and then this is taking some of these numbers and giving you a projected max days on this particular sequence. It still, it's 100. It's looking at what the max day held date is, holding to July of next year.
Okay, so this is not long in the tooth then?
No.
Good, because I bought it.
Yeah, so no, it's not. So it has been, you got this high level consolidation going up here, but yeah, just looking at this thing.
Okay, so while you're on that screen, the PPMs, which I know are proprietary, so there's a certain amount you can't tell us, and that's great. I still am unclear as to those derivatives and how to interpret those. And I watch all your videos all the time. I'm just like there's the first and second derivative, but I'm still unclear on how to look at those.
Yeah, so I talk about this all the time on these trends that we get into trend mode. It's momentum followed, then it goes into these maintenance, and I'm just drawing these in. So what usually will happen is these indicators will kind of get to this a positive zone, like this is 2.5%. So that was huge. When this thing spiked up over here somewhere, it just jacked up that big time. So it got out, and then the thing exploded. It got back in. But what we were in is what I refer to as a trend, like in a trend phase. And we could go through every trend phase and mark these up. And they typically will stagger in on the time zone. So like this one, this one came in here. This is tough to draw with this tool I got. This one came in here, and this one should have been first. So this is the shortest term. This is the 10, 21, and the 40 period moving averages. And what happens is this thing will explode up, and it says, oh, this is a trend. And somewhere around, I don't know where this video lies, but there's what we call, what I refer to as phase 1, 2, and 3 buys on the models. And so this would be a phase 1. This would be a phase 2 buy, actually. And then this phase 3, and what that means, this I used to joke and call it the Jim Cramer trade, buy high, sell higher. And these trades have typically will have a lower probability of extending like this one, but they do happen. So this trade here, this is 3-2, so this one isn't as dangerous. If this was a 1-2 model instead of 3-2, that would be that there is a trade that literally only happens about 3% of the time, but it can be dangerous. But this construction of this trend is exactly what this model's playing into. Is okay, we got a trend, it's maintaining, PPMs are greater than a certain number. So I'm hoping with the conversation I had, I'm not sure when it's going to happen, but we're gonna get so you can get mouse over values on the PPMs, so you can get exact values on all these numbers. I talked to my IT guy the other day, and he doesn't seem to think that's going to be hard. So hopefully we're going to have some sort of update on some of this stuff coming out maybe soon. I'm actually working on putting market grid on every symbol in this NPX. So anyway, yeah.
All right, great. Thank you.
All right, we always keep going. Now we're 2 hours. I love it.
Well, and the stock screens have been posted on the website. We mentioned that so everyone knows the new ones are up.
Yeah, so let's do that.
And Kerry had his hand up. I was trying to message him to let him know. Hopefully his mic is working. I was helping him the last few weeks.
Yeah.
Hi, Kerry. How you doing?
Hi, good. Can you hear me?
Yep.
Hi, Bob. I just want to thank you for all that you do for us.
Oh, thank you.
I was actually caught up in that correction in September, and got a beating, and found your channel on YouTube. And ever since then, I've been waking up at 2 a.m. My wife, what are you doing waking up this late? I got to listen to Bob Sugar. So I call you Bob Sugar.
That's funny. I've been called worse, by the way.
From Jerry Maguire.
Yeah, exactly.
I got Bob Trigger on the line. Show me the money.
Show me the money.
Yeah. So, so I've actually been following you along since then, and when you say things are going to turn, I get out. And when you say things are going to move, I get in. And
yeah,
I've been playing my own stocks, and I recently subscribed 3 weeks ago to the portfolio, and I'm blown away. I don't have to wake up at 2 a.m. anymore. I can just go on there, and I can see that it's 38% on the daily and 76% on the weekly, and ppm's picking up steam, and it looks like it's going to be a nice little run coming in, unless something changes, unless the fairy godmother decides to do something.
Yeah, but I on my Twitter account, I've changed her name to the Wicked Witch of the West. So she's not as friendly as she used to be. She's
between Yellen and Poo Poo Powell, we'll see how things go.
Exactly.
But yeah, no, I love it. I mean, I haven't built any portfolios yet, but I love it. So like today, I see that Capital Goods has a
new buy.
Has a new buy, and then I went in there and I clicked on it, and I'm just messing around still. I'm still learning it. Jay said it'll take me about 2 to 3 months to really get some momentum with the software. But I'm already learning, so and then I click on aerospace and defense because being a veteran, I like to keep an eye on where the government's spending money.
Yep.
Those $5,000 toilets. Got to see.
Yeah, I know. That's what I'm worried about with this stimulus, right?
Yeah. So that's why I kind of gravitated towards the aerospace and defense, and then I look at it and I go, holy cow! I think Lockheed Martin, which I own, is almost at the end of its run.
Yeah.
And it's got some room, it looks like, but then I see something like then I see something like Honeywell, which I wouldn't think of as a defense stock, right?
Right.
And then it's great how you have them all categorized, and I can see like Honeywell's 5 days in and it hasn't started its run yet, so I love the fact that I can close one position and see where the momentum's going to be in something else, and kind of just ease into it. Not like don't go all in. I don't want to have what Marilyn had happened to her.
Yeah, no, it
happened to me. But you still got to use some trading basics. But one thing I'd love to see from you is your experience. Is there? I mean, don't worry about the trolls and all.
Oh, I don't. Trust me, I don't.
But your experience is there. I would love to learn, some of those little trading techniques. Where you ease into a trade. Quarter a position at a time, and when things have run and when things are coming to the end of the cycle. Because it's great that you do the YouTube videos for everybody, but I would love to get those little details that'll help me, manage my retirement.
Yeah. So we are working on a master class for the management side, not so much the micromanaging, but the management. So we're working on, it's a big project. And so we're working on, we got a lot of stuff. I won't put any dates out there because it's impossible to, it's hard enough just showing up every day sometimes to keep up with everything.
That'll be great, and thank you for all the energy that you put into it. I really do appreciate it, and I can see the potential of this tool.
Yeah, when you figure out how to start building the portfolios and diversifying, and you could do, JD, we have a pre-built on aerospace.
Yeah, I do. I'm trying to think. Well, I have two different ones. One is war games, but that's aerospace and what's not fair because GME beefed it up at the beginning of the year, but it's aerospace and all the video game type stuff. So it's war and games put together. But I do have like mission control, which is all aerospace type stuff.
Yeah, so you can see that in the subscriptions on the page. So if you don't know where to get to that, Carrie, let me just.
Well, and some of that's still on my own list. I haven't actually made a Premiere.
I thought you had that in the Premieres. Okay.
No, I'm sorry.
Yeah.
Yeah.
Yeah, Jay's got
I
these
can
secret.
get it in there. Yeah, this is my own. I don't want to share that.
Yeah, I thought that you had those in there though.
No, not yet.
Well,
I can make them available.
Well, I look forward to learning more. I just wanted to come on and say thank you.
I appreciate it, really do.
Keep on keeping on.
I will. And the trolls don't bother me.
Yeah.
I used to work on trading floors. It's like a war zone. So, that was, that was a much more interesting environment. The trolls were limited, but they could be aggressive. So that's okay. Yeah, I actually like playing into those guys and giving them some fuel sometimes.
Yeah, keeps it lively.
All right.
Bob, I did have one more quick question.
Sure.
Oftentimes when you're looking at the PPMs and the trends and the levels of the PPMs, and you'll say there's only a such and such probability for the market to decline. How do you convert those? How are you converting those PPMs?
Somebody asked me that before, and they go, "Give us the metrics." So, so I always talk about the 0.25 being a trend, and so I need to do. I believe on the channel there is understanding the PPMs. Have you seen that video?
No.
There's on the channel. I'm going to divert you to that, but I think I have to watch it myself to remember what I did. But what I talked about some of the stuff, but it would be nice to have some of those trigger points that you know what the probabilities are, and the whole process behind these PPMs are determining trend direction, number one. Number two is probabilities of moving averages to hold values. So we've all looked at moving average and go, look, it bounced right off of that so-and-so, 10, 50, whatever you use, right? So what the PPMs are about is they measure percent change per second derivative of that change to determine when it's likely to lose momentum or when it's at a momentum point that tells that there's a high probability of it staying above that number. And that it gets shown all the time, especially in the daily videos. And I've been talking about the 10-week moving average, NASDAQ, S&P, and go all down the line, that those things have been the primary, what I call demand line. So what you'll see is that's where the buyers, the buy the dippers, are coming in, and especially when you have a PPM, levels that are sustaining well above 0.25. Some of these levels on the intermediates are, in the whole numbers where they're 2.35. And when you get above actually 1.5, it's 10% probability of it even declining below that level. If it does, it's a buy, and it happens all the time. And I think if you watching the videos when I reference all of that stuff, it's going to be interesting because gold is trying to play with some of the upper resistance numbers that are happening right now to see how these probabilities play out. But so I need to put a map out to everyone. I have to, but watch that video. There's a section in the channel that says understanding my process. And if you go there, you should be able to watch that.
Okay. What's that video called? Do you recall what the name of the video is?
I think it's understanding VPMs, I think.
Okay.
Let me.
I think it's exactly understanding the
PPMs.
And is that on the YouTube website?
Yeah, on the YouTube channel. Yep. So if we go to the channel, there is section understanding my process, how to use market grid PPM indicators.
Okay, great, thank you.
Right there, yeah.
And those PPMs, they must include, they're calculated with price and volume and slopes and things like that, I guess, right?
Yeah.
Well, I mean, it's all in the video. I'll watch the video, Bob.
Yeah, watch the video. Yeah, it actually is only looking at moving averages. So it's defining. I did something interesting. Myself and one of my old partners back in 1983, we came up with this. We were using moving averages like everyone, right? And let's see here. I'm just going to stop sharing here now. So we're going to try to get that. There we go. So I'll come back on here now. And we got everybody that's still hanging out. But yeah, so the concept is that moving averages were used by everyone, and we were trying to figure out, well, how come it bounced off? How come it didn't go through that time, but the last time before when it got there, it did? So we started studying what we call the angle of attack, and that the PPMs measure the percent change and first and second derivative. So when they start to cross over, that's when I would tell you that, hey, it's crossing over, PPM 1's starting to cross over its first, second derivative. That means it's going to the next trend level, which would be the 21-day moving average or the 40, or maybe it reverts over to a weekly average, which then is where I usually do a bottom-up analysis, so daily, weekly, and then monthly. And so I always have a context of where they are. So once you understand trends at that level and you understand the probabilities of what might happen around those moving averages, it makes life much easier. And that's why when somebody was asking about the valuations of the markets right now, it's very the trends are just so strong, you just can't ignore them, and they just keep grinding up. And I think when you have trillions of dollars being thrown around, there's just so much cash flow, it's got to go somewhere. And industries, business, everybody's going to have that cash flows around everywhere, So you've got the folks predicting, like Ray Dalio is, talking about the worst a period worse than 1929, and we're at the end of a debt cycle and all that kind of stuff. I mean, he may end up being right. That good for him if he figured it out 3 years too early. But that doesn't have anything to do with investing money, and that's why the PPMs are understanding when you start to look at the monthly, and I usually try at the beginning of the month, I'll cover monthly, weekly, and daily so we have some perspective. So going back to those first videos, typically that Sunday night video at the beginning of the new month, I try my best to, I have a list of things to do beginning Sunday nights are where I focus in on a lot of those details. But watch that video. I think that'll help.
I have a request related to that. Is I've watched that video. I have to go back and look at it again. But what would be really helpful to me is if we had a training session like this, where you walk through that analysis you do on a daily basis, but broke it down into, okay, because of this, I'm thinking that, and so on, into simple steps for, the more people who are challenged in that area, like me. And then if it was in an interactive session like this, the questions and answers, I think, would probably... Yeah, why not just do understanding? Yeah, I like it. I like the idea. Yeah. It's the crux of everything I do. I mean, you got to figure that out from watching a couple YouTube videos. Oh yeah.
But it's understanding moving average, understanding patterns and trades and all that stuff. And I don't actually put the models out as much as I should on the YouTube channel. I try to just keep it a raw analysis so that it keeps it. What I try to, my attempt is to keep any bias that I looked at a model and say, oh, our models are long, so I have to think like this, right? So that's why I don't actually bring up the models that often on the daily, because I'm trying to stay objective. And, like I do this every day. I have a no look zone every day in my analysis, which is once the market closes, don't look for at least 3 or 4 hours. And that's why I do the videos later at night, because I need that detachment from what just happened. Because if you have a big market day and you're still watching the market closes, you can still feel that. I used to walk off, I used to joke, and it's true, you could go to, back in the day, go to trading floors and just stand at the bottom of the elevator at Chicago Board of Trade at the bottom of the escalator and look at the faces coming down that escalator, and you can see what kind of day everybody had. You could see the guys that were going to bars, they were partying. You could see the guy that was looking at the stairs going down. You know what happened. And so, it's just trying to keep that emotion out and trying to keep everything. So you have to detach from whatever happened. When you come down that escalator, I had a really close friend and actually was an investor in one of my companies once upon a time. And he was the largest trader on the Pacific Options Exchange. And I've gotten in the elevator at the second floor. Our offices were on the 6th floor. And I remember one day this guy had lost some money, and we got in the elevator, and the building, we were in San Francisco, the building we were in were a bunch of pinstripe wool suit attorneys in that building. And we got in off 2nd floor, smelly jackets, and got on the floor up on the elevator to go to the 6th floor, and Mike was just ranting about something. I swear everybody moved to the back of the elevator like this guy might be psycho. And we'll just say him and his brother are worth almost $1 billion, so he wasn't a psychopath, but he was pretty upset. And we hit the elevator. When we walked out of the elevator and we punched the code in to go in the door, he punched the code in. I walked in behind him. It was like nothing happened. So that he was able to get that detachment. I always think about that day. And then I asked the clerk that handles his accounts, to ask him how much he lost. He lost $80,000, which is a rounding error to this guy. And you would have thought he lost like some serious money, but he used to always say he hated losing money, but he was able to take that little elevator ride from the 2nd to the 6th floor and detach. And I always reminded you got to break away from whatever that was so you can come in, etch a sketch, so you can draw some new lines. And I think and if nothing else, psychologically, it's really good for all of us when the days are big, just to detach. I literally, when the market closes on Friday, I typically don't even open up Wavetech until Sunday when I'm ready to go to work. I sometimes on Friday night, if I know it's a big night, I'll look. But for the most part, I just detach. There's nothing I can do about it. It is what it is. I'm going to look at it, do my analysis. So, you have to have a peace of mind, especially when this is what you do. So, sorry for the long answer.
It's all appreciated.
Well, that's good to know, Steve. I appreciate it. So, listen, thanks everybody for hanging out. It's always fun. It's hard to get off these. Jay and I've talked about this. I'm actually breaking every rule I told him right now. So, anyway.
Yeah, you're always telling me, "Oh, are you not off? What are you doing this for so long?" Yeah, it's easy. Try to get off.
Yeah,
you can't just end it.
That's pretty funny.
Actually, you know what? I think I'd like to just propose the adjournment of the meeting on the note that you're excited about the idea of telling us about how to interpret the PPMs.
Yeah,
that'd be great.
Yeah, no, I think we need to think. I think that would be that's what we do one time. Maybe we would just start breaking down components, and even talking about why 10, 21, 40 period moving averages. There's actually another average there that's out there as well, and I am going to stop recording, Jay. So.
Okay. Now it's off the record.
Now this is off the record. Yeah. No. The reason why I wanted.
Good day today. Thank you very much, Bob and Jay.
Yeah, you guys are welcome. Seriously, Scott, I appreciate it. We just these things. It's fun hanging out, and I guess we've all been locked into rooms, and God knows what over the last year. So. I'm actually going to venture out into the world next month, so we'll see how that goes. So anyway, folks, thanks for coming. Marilyn, please reach out to us. I definitely want to know more about what's going on there. So hopefully you hear me, and it looks like you're still with us. So send us email, info@Kendall Report, and we definitely want to take a deeper look into what that situation looks like. Okay. All right, folks.
Yeah, thanks a lot.
Okay, all right, bye, thanks.
Thanks, Bob.
All right, thanks.
Thanks a lot, Bob and Jay.
Great hanging out,
You're-
man.
Thank you,
You're
guys.
welcome. You're welcome, everyone.
Thanks, Bob and Jay. Have a good one. Speak soon.
You too, Wayne. Yeah, Mr. Tater said it's time for a keto salad.
What is a keto salad? He's going to have to share that.
And he was on Zoom earlier. He was having trouble with the sound, so he went to Zoom.
Oh, okay, that's why he
YouTube
went
or
over
something.
there. Yeah.
Yeah. Someone else was trying to talk. Sorry.
No, this is Damon. I was saying I think that keto salad is called a hamburger, no bun.
There you go. You know, if you're buying In and Out, they have a thing called the Flying Dutchman, and all it is 2 patties with cheese. That's it. No lettuce, no nothing. They have a protein style, but you get a Flying Dutchman, and that's what it is. They put a piece of paper, throw a couple of patties on it, throw some cheese in the middle, and you're good to go. They don't put anything on it.
Probably the first meal they serve you in heaven, right?
Probably, huh? That and Aruna.
Absolutely.
All right, guys. Talk to you soon.
Thank you.
Yeah. Bye.
Take care.